All right.
We are living in Brittany's bubble today. Today is our first show. This platform is meant for you guys to get real life information. It won't always be just about the market. We will be adding more topics to come. So please include comments today. Let us know what you would like to know more about. Without further ado, today we have Brooks Kelly with the Mortgage Link, and we will be talking about home affordability in today's market. So let's go ahead and get started. Brooks, tell us a little bit about yourself real quick.
Sure. Yeah. Thanks for having me today, Brittany. I'm honored to be your first guest and here with you to talk about the crazy real estate market that we live in. So, it's October and it's completely different than it was 10 months ago. We started this year, really the first day of this year. We came back from New Year's break, and from day one, the interest rates started going up. The forecast for this year was to see rates in the 5% range, and we blew that past that like by April. So we've seen the market change significantly from people bidding over to people now having an opportunity to purchase a home. And so we've been fortunate to be in this market now for 15 plus years. I've been loan officer, branch manager, now EVP of sales of the Mortgage Link. So we're hiring loan officers and branches and things like that while still originating loans. And I've done loans for thousands of clients, purchase, refinance, construction, renovation, whatever it is. We're here to do it for you. And fortunate to be in Dallas, Fort Worth, where it seems that no matter what happens in the world, people are still buying houses. So thanks for having me today.
Absolutely. So glad that you're here. So obviously the big question with the interest rates on the rise, homes are still up. People are wondering, can I even afford to buy a home in this market? And we'll definitely get into that. But before we do, let's talk about the elephant in the room here. Where are the rates right now?
They are pushing close to 7% today for someone with good credit and a solid down payment. So it's like I said, the target was 5 and now we're close to 7.
Wow, Brooks. Now, where do you think that they're going to go by the time, I don't know, like let's say Christmas time, December or January? Where do you think rates are going to be around there?
Well, I wish I had that crystal ball. I would have known this was
Don't
going
we
to
all?
happen. But my opinion of that is we're going to continue to see rates increase a little bit all the way through the end of the year. So the reason that rates have gone up is because inflation is up. And the federal government's trying to get a hold of inflation right now. So they have to raise the federal funds rate, which has been at or close to zero for the last couple of years since COVID started. And they've increased that in 50 and 75 basis point increments. So 0.5 to 0.75% every time they meet. And they will continue to do that, I believe, in the next couple of meetings to where they push the federal funds rate over 4%. And then I think they're going to take a pause from there, which I think will kind of settle the markets a little bit. And that means interest rates will probably be in the 7s for the next 3 to 6 months, probably. And then they'll see where inflation goes from there. Because a lot of the indicators of inflation they lag, and it takes time to really get a good reading on that. And the monetary policy that they put in place will also, take time, to catch up as well. So for employment rates, for bringing down inflation costs, and then the supply chain to catch up, which is still probably one of the biggest problems that we have. Is I know when I go to the grocery store that they're still missing a lot of items on the shelves. And so that's like that in really every industry. So.
Absolutely. And so what we're seeing right now too, and I ran some data points before you and I were going to hop on this call, and it was interesting. So I'd like to talk about what we are seeing as it relates to the interest rates in the market. The median sales price year to date is up $60,000 in Collin County. And
Wow.
yes, we've seen it taper, off a little bit since May. But what would you say to someone that is wanting to wait this out and see where these interest rates are going? What would you say to them, just knowing that information alone, that the median sales price is up 60,000 this year?
I would say that waiting to buy real estate has in only very, very few occasions been a good idea. My evaluation of the market is you buy when there's an opportunity. And so it depends on what your opportunity is. A lot of people's opportunity this spring was to not be able to buy because they were having to pay 50, 75, $100,000 over list or appraisal value in order to get a house, in
Right.
order to secure a lower interest rate. We told everybody for 2 years, like, this isn't going to last forever. And
Yes.
then boom, it started going and it didn't stop. And so everybody, it became a frenzy, right? And it raised the prices. And they've probably come down a little bit. Is that what the numbers told you as well? Or
Yes, they have tapered since May. The median sales price in May in Collin County was 590, and we're at 535 right now.
yeah, I expect that 590 was probably a quick peak as well. So, obviously from 475 to 590 all in 5 months, right? That's too fast, right? So houses
Absolutely.
have to come down in value. But I think we're seeing a lot less decreases in sales price recently. Like, a lot of homes on the market are reducing their sales price, but it's not by much. But it's because they were overpriced in the first place. They were following those numbers from May at 590, where they should have been more 530 or 540, right? To be more in line with the market. So I think that part of it's slowing down. There's still an inventory problem, right? There's still only 3 months worth of inventory on the market, something like that.
In fact, in Collin County, we're at 2.4 months
0.4.
of
So
inventory.
yeah, so a healthy equilibrium in the market is about a 6-month inventory. To have, a buyer's market is 6 months inventory. So it's still very much a seller's market. Yes, the sellers are decreasing their price a little bit, but ever so slightly. I think those decreases are slowing. I do believe that many people think that Collin County is a very affordable place, because 540 in LA is, it's a piece of dirt if you can get that, right? So we still have a lot of people coming in from Chicago with Caterpillar or LA and all these different Fortune 500 companies coming in here from places that are much more high cost than what we have here. You can get a lot of house for 500,000 in Plano and McKinney and in those areas. So affordability is all in the matter of perception, right? And what's somebody from California's perception versus someone from Plano and born and raised in Plano is very different. So keeping those in mind as well is a factor that many people don't think about.
Absolutely. Brooks, let's talk a little bit about combating this interest rate. So if we have, a buyer in the market that is looking at a home, where's their negotiation leverage here, especially knowing that, the inventory or the month supply is definitely picking up a little bit. There is some negotiating leverage where they didn't have it before, right? 6 months ago, you have multiple offers, you're against, tons of buyers. Let's talk about that because, and I'll tell you why. Because when we look at the percentage, the sales price to the sale price, list price to sell price, I'm sorry, that percentage, before COVID, we were around 95%. And right now we're at 96%. So we're coming back down, which basically means that if a home is listed for 100,000, that the seller gets, 96,000, right? Just for layman terms. So
Yeah.
Can we talk about how buyers can leverage where we are, where these list prices are tapering down a little bit for their benefit to combat that interest rate? Did that make sense? Did my question make sense?
Yeah, I think there's a lot of benefits from a financial side and from just a due diligence piece. Like there were many contracts written without option periods or, without the appraisal addendum. They were just saying, hey, whatever it appraises for, I'll pay. But now I think you have a little bit more leverage on contract side. You might be able to get them to pay for title policy and survey. But also you have time to inspect and maybe negotiate for repairs. We have seen that a lot where they may go under contract with no closing costs, but they come back with some repairs, and instead of making the repairs, they might give them $2,000, $3,000, $4,000 to repair the property. So that's changed from that aspect, and just the time. And you can think about it in a lot of cases where, you know, it's not 50 offers on one house, highest and best by Monday, and, you know, best offer wins. There's some negotiating, which is really where real estate should be, is there should be some sort of negotiation. Now we've got some tactics from a lending side and a financial side that can help too. And these are not brand new concepts. They're just things that have not needed to be in play for the last, you know, 15 plus years. But the temporary buy down products are great. The one that I like the most is the 2-1 buy down, which essentially, say the rate for easy of terms is 7% today. You do the 2-1 buy down and it brings your first year rate down to 5%. So it's 2% lower. And then year 2 is 6%. So it's 1% lower. And then years 3 through 30, it's at 7%. So the cost of that is about 2.3% of the loan amount, which the seller has to pay for you. So instead of maybe getting a reduction in price, you ask him for, you know, a $10,000 seller concession that will pay for this for you. And the reason behind it, and the reason I think it's a good option rather than a permanent buy down, is because the market will cycle. Interest rates will go down, and they should go down in the next 2 years. They typically go down at the end of a recession. So that's where we're headed if we're not there already. And so as the rates peak, they'll come back down, and in that 24 months, they'll be able to get a better permanent interest rate on the other side. Now, if you use those points to do a permanent buy down, it might take the permanent rate from 7 to 6.5 or 6.25 or something like that, which gives you a lower payment for the 30 years. But most likely you're not going to be in that loan 3 years from now, let alone 30 years from now. So it might be better used to put towards that temporary buy down situation to make the payments more affordable for you.
Absolutely. And I'm glad that you said that, because, you know, running the numbers and looking at the list price to sales price ratio, you know, sellers are already, you know, selling at, you know, 96%, 95%, right? And so on a $400,000 sales price, that's $20,000. So, you know, for a 2-1 buy down, did I say that right?
Yep.
For a 2-1 buy down, that's really only costing the seller $10,000. So that may be something that the buyer's most interested in versus reducing their sales price $20,000 or whatnot to really get it sold. So I think that's a great point, and a win-win for both parties.
Absolutely. Yeah.
I love that. So what would you say if someone's on the fence deciding if they are wanting to renew their lease or purchase a home right now?
I would say that you need to explore the opportunity of home ownership. If you're in the position to be able to do that, there's no reason to wait, because return on investment owning a property is significant. And so, like, if you think about it from an aspect of, say, putting 10% down on a $500,000 home, that $500,000 home is the asset that's appreciating at 3 to 4% per year, like a lot more in the last couple of years, but, you know, on average, say 3 or 4%. It's not your $50,000 that's appreciating at that. So the sooner you can buy a home, the better. I think there's a lot of people, we talk to a lot of clients that are like, well, I'll just renew for a year and see what happens. Well, they also did that last year too, right? And so they missed that opportunity. Well, when you're locked into that lease for another 12 months, you know, you might be at the other end of that, and rates might have come back down. House prices might have come down 3, 4, 5%. But guess what? That's the perfect storm that everybody else is looking for, right? So now you're back in the market with everyone else having the same battles that you had this spring. Now you're going to be over list price. Now, you know, it's going to be a battle for you to get a home under contract. So I hesitate to tell anybody to wait if they can afford to buy today.
I would agree with that completely. If you look at I'm looking just over 10 years, the median sales price in 2012 in Collin County was 196. And as of September, it's at 535.
That's
And so
insane.
really, I think that my greatest fear for, buyers in general is if you're worried about it being affordable now, I'm more worried about it being affordable later because these home values are continuing to increase. It's great for home ownership, right? So we want to jump in as soon as you can, like yesterday. But at the same time, if you keep staying on the sidelines, then it's becoming further and further in that reach. And so that's my concern for those that are continuing to rent. So
Yeah, 100%. Collin County is the number one or number two county in the country for appreciation over the course of that period of time. And it's not going to change, right? I mean, you watch the homes being built there, it's obviously the footprint's getting smaller and where they can live, but the amount of Fortune 500 companies that continue to move here, and the economy here is so diverse that there's no way for that to go down in a significant way. If you're waiting for interest rates to go down, that's not the thought path that you should be on to be a homeowner. I mean, 70% of the mortgages that were done in the last 2 years were refinances. It were people that already owned a home and they
right.
bought it because they needed a home and it fit their budget and all those things. And then they had an opportunity to refinance it and get a better payment on the house that they already own. The perfect storm of buying at the perfect rate is the wrong thinking because it just doesn't work out for that many people. It'll work out for a few, but to get the right house in the right neighborhood at the right, time for your family, you just have to be aware and be in the market. You can't just sit and wait for that perfect time.
Absolutely. And what we do know for sure is that interest rates, they go up and down, right? The home values, they continue to appreciate. So we are going to continue to see an increase in those home values. So jump on when you can, right?
Yeah.
That'd be the advice, and obviously refinance later when those interest rates decrease. So that's awesome. So glad that that you said that. Is there anything else that you think that we should cover today, Brooks, regarding home affordability, interest rates?
Yeah, I mean, many people are they just don't think they can buy. Like I talk to so many clients that are like, I don't know if I can qualify or not, and so many of them do, and they just don't know that they can. We look at three aspects when they're qualifying: cash, credit, and income. So if they have the credit score, that's the first factor to be able to play the game. So a 550 or 580 credit score gets you into an FHA loan. 3% down or 3.5% down gets you into the house, which can be a gift from a family member. So if you got mom and dad or grandma and grandpa that want to help you, or if you have a 401k to pull money from, like that opportunity is there. And then it's, do you have the income for it? And, that's the biggest piece. And buying a home before you're ready is definitely not the right thing to do, especially from an income standpoint. But stable jobs, two dual incomes, all those things, single incomes, like, as long as you're comfortable in your job and your income and that payment fits your budget, then, and you have the credit score, then everything else is doable. I mean, like I said, 3% down, you can get into a house for $300,000 home for $10,000. If you can get the seller to participate in some closing costs or whatever, like there's just opportunities galore out there. And I mean, I bought my first home back when there was 100% financing in 2005. And just the amount of, I don't own that home anymore, but I bought it for 130,000 back then. It's worth 300,000 today. I wish I still owned it, but just think about that appreciation over time. So
Right.
Same thing, that $300,000 home is going to be worth 600, in 15 years from now. So that is the number one wealth building opportunity for every middle class person in America. And so don't get sidelined by the news and what they're telling you on, MSNBC. It's just not the case. Look to the local experts for advice, ones that have the data like you just shared. Like nobody's sharing real live data like that. And if they are, it's on a nationwide basis. It's not in your local market. Collin County, Dallas Fort Worth is, like I said from the beginning, one of the best markets to own a home in anywhere in the country, and has been ever since I've lived here. And it's not going to change anytime soon.
Absolutely. Absolutely. You have answered so many questions today. I really appreciate that, Brooks. Is there anything else that we can cover? You think that'll clear up the big mystery if it's still affordable here in the DFW area? What's the big answer? What's the big
I mean,
answer?
man, I could talk for hours, like you just want me to talk about all kinds of financial things, and we could go on forever. But I mean, home affordability is not gone. Like we have more dual income homes over 130,000 or 120,000 in DFW than any other metro area. So a $3,000 house payment versus a $2,500 rent payment is the right direction to go. Like you need to step up from that rent and move into a home. It's stability for your family, it's stability for your kids, the schools that you want to be in and all that. So outside of the financial aspect, like owning a home and owning a primary residence is for families, to have stability. It's not about the investment. The investment is the ancillary secondary part of it, right? Like you gain this equity and this wealth, but really you're buying a residence, a home, a place to raise your kids. And that's really why you buy a primary residence. So, don't shy away from it for any other aspect other than you're not physically, or financially ready for it. And that's something we can help you evaluate. We have a budget plan we'll show you and help you get ready for it. If it is like, man, maybe you do need to pay some debt down, get rid of this payment or this student loan or whatever it is. But so many times that opportunity is there for people. And then the other side of it is, a lot of people are buying second homes and investment properties. I think 1 in 6 loans done today is an investment loan. So investors are seeing this opportunity too. If 1 in 6 homes is going to an investor, they're looking at it from a financial standpoint. So, that it actually makes sense all the way around for you, especially if you're going to live there. So
Absolutely. I was running some numbers on a lease that leased out a couple of months ago in Woodbridge in Saxe. It's also Collin County. We have an investment property there on the same street. And I was blown away. It's a 4-bedroom, 3-bath, little over 3,000 square feet, and it leased for $33.95 a month.
wow.
Ran numbers on that for the purchase side, same house, right? Everything plugged in on a 2-1 buy down. And that mortgage would have been $400 more than, essentially $400 more than that rent. And it just blew my mind. And so I think you bring up a great point that people just got to try, just run the numbers and really dive in and see what makes sense. And if it doesn't, then it doesn't. But I think there's a lot of fear out there, and media, the media is not great about giving the right information, and they put a lot of fear in people. And I hate that's happening. So this is why we're doing what we're doing today.
For sure. Yeah. A lot of people bring up 2008, is this another 2008? And it's not, the equity that's in the market. I mean, I think it's 50% of the value is the equity. I mean, so many people own their homes for cash. Every loan that's been qualified since Dodd-Frank was enacted in 2009 has, the cash credit and income. They check all those boxes. They have the down payment, the stake in the game, all those things, the appreciation that we've seen. There's not going to be massive foreclosures. The massive foreclosures that we saw were due to just crazy lending standards, 100% financing investment properties with 550 credit scores. Like it was crazy. And we haven't done one loan like that in the last 14 years. So that is not going to happen. Will we see a decline in value ever so slightly? Like you said, that amount is decreasing ever since people have gotten more in line with their right sales prices, but we're still up 60,000 on the year in Collin County. Like that's 10%, over 10%,
Certainly. So obviously interest rates are higher. with that being said, some folks are not doing refinances right now, but what if they need to pull some of the equity out in their home? What's a good solution for them if they need that, for whatever reason that may be, whether they want to put floors down in their house, do some upgrades, or maybe they need it for, college fund for their kid. Is there something that they can do right now with the interest rates being higher? Can you talk about that?
Yeah, there's three options to pull equity out of your home. You can refinance the loan that you have, but if you've got 3% on that loan, you're probably not going to want to refi it for 7%, right? So option 2 is you leave that loan in place and either do a home equity line of credit or a home equity loan. The difference between the two is the home equity line of credit is it's like a credit card. You can pull on it and pay it back as you want to. And so the payment's not fixed, it's variable. The interest rate's also variable. So that's the little risky in there. It's usually prime +1. So whatever the Wall Street Journal prime rate is, which is like 4.5 or 5 today. So add 1 to that and the rate's say 6%, but it's only on that small amount of money. And then the other option is the home equity loan, which is a fixed payment on the same thing. So you get the whole chunk of money at you all at once. And then after that, you have a fixed payment, paying it back, usually on a 15 or 20-year term. So there's lots of opportunity on a primary residence. You can cash out up to 80% of the current value. So as you've seen your equity rise, like that opportunity is there. So I think there's lots of options for that. We also have a lot of people that take that money and use it for the purchase of their next house as well. So where you use the money is up to you. It doesn't, there's no restrictions on that.
That's great. That's great.
Yeah.
Brooks, we've covered a lot today.
Yeah.
Is there anything else that we should be going over, or you think we've covered it all?
I think we gave them a lot to think about today. So I would love to come back and answer any questions or anything that you want to discuss in the future. But I think, there's a lot of ground that we covered, and I think you'll get a lot of good questions out of it. So.
Well, I embrace them. I would love to have some questions and also some more content ideas, as we definitely want to bring value to our friends and family. So Brooks, I'm not going to keep you any longer. I appreciate your time today and all of your insight and knowledge, and I'll see you next time.
Sounds good. Thanks, Brittany. Have a good one.
Bye.